If you have ever felt like you are working hard financially, but still not getting ahead, this conversation is for you. Many people are taught to think about mortgages, debt, and money management one way, but there are strategies that can help create efficiency and flexibility with the money you already earn. Welcome to Biz Help For You, where passionate support and practical guidance help your business thrive. Today, we're talking about money and mortgage efficiency and how understanding the way money flows can completely change the way you think about debt, cash flow, and long-term financial stability. Joining me today is Michael Newmann. In this conversation, we're discussing the all-in-one home loan, common misconceptions about mortgages and debt, and how individuals and business owners can use financial strategies to create greater control and flexibility in their lives. Michael, welcome to the show.
Thank you so much, Candy. I appreciate the opportunity to be on here and looking forward to a great conversation.
Thanks. I'm looking forward to this conversation too. And I'm sure people are going to be interested in this concept because so many people do have mortgages and they're trying to deal with their money and finances. So if someone is hearing the phrase money and mortgage efficiency for the first time, what does that mean?
It doesn't seem to necessarily go in the same sentence, mortgage and efficiency. So what it means is the ability to actually control something, the mortgage, which we haven't controlled it. So we basically have learned that when we sign on the dotted line for a mortgage, typically amortized, 30 year, 15 year, whatever the term is, that's it. So we have one thing that we can kind of control in the beginning, and that is trying to get the best rate we can get, which is the first question anybody ever asked me, what's your rate? Because we think that that's kind of the be all end all. But so once we sign, that's kind of it. And it doesn't matter what life throws us. It doesn't matter if we do good or we do bad. That mortgage is still coming, and it's the same amount. And so we get used to that comfort. But and so efficiency would be where there's actually control in that, and we can actually do something to even lower our payments within the constraints of the mortgage. And that's going to really raise some eyebrows, like, okay, like how's that possible? So that's the carrot I can dangle there as far as mortgage efficiency.
Sure. And I'm sure we'll get more into that topic too. But even when you were talking about, changing the rate, of course, we know you can refinance or things, but you're saying what we're going to be discussing is something you don't even necessarily have to refinance to be able to get that changed, correct?
Yeah, absolutely. Yeah, and that's one of the best parts because a lot of us, have been on this crazy train of a cycle of every 3 to 7 years. We end up doing, rate cycle, and we end up doing something different, whether we're purchasing something different because life has changed, or we need something different, want something different, or the rates have come down, and so now there's an opportunity to get something. Well, we pay closing costs each time. And I've been an active participant of that because I've been in the mortgage business for about 20 years. So I like that. That's how my world goes round in business. However, it's costing money. And a lot of times people are resetting back out to a 30-year. That's a problem a little bit if we don't do the math, because the first 5 years of a mortgage are basically interest. So yeah, sure, you can refi. But there's a cost behind it, and is that the most efficient way? Before, we're like, well, what are the options? There isn't any. So there hasn't been, but yeah.
Sure. Well, in the intro, I said there's something called this all-in-one home loan. So I would love for you to say, really, what is that, and how does it differ from a traditional mortgage?
Yeah. So the all-in-one home loan is a mortgage, by the way, that is not something that just happened. It just came out. This has been around, and I'm kind of ashamed to say it, for 20 years. I've only known about it since 2024. But anyway, irregardless, what it is it's basically a banking or checking account fully integrated, okay, with a line of credit, which becomes your mortgage. Okay, so we're used to amortized mortgages, which means we have a term, and based upon your rate and your term, it comes up with a payment, and that's what the payment is, period, end of story, that's it. Okay. Whereas this is complete opposite. It has full integration with a checking account. And what that means is, and this is very weird and odd compared to what we're used to, because we're used to checking over here, banking, and mortgage over here has nothing to do with each other. So this is literal full integration. So what happens is when we deposit funds into our all-in-one checking account, it immediately is pushed to our line of credit, our mortgage. So it, no choice. Okay. So it literally reduces our principal on our mortgage by that full amount. And at first it's like, oh my gosh, that's scary. I don't want to do that. Well, I got to spend money. I have bills. I have all these things. Yep. So remember, when we push money into a checking account now, what does it do for us while it sits there? Nothing. Nothing, nothing, nothing. What does it do for us while it sits in the savings account? Nothing. Okay, so come back into the all-in-one. It's reduced the principal on our line of credit and thus our mortgage. Interest is calculated that night on that new balance based upon what you've put down. Okay, interest is calculated, swept away, and we start again the next day. Now, the key is you still have full access to 100% of what you just paid down in your principal. So therefore, everything you were just worried about, you still have. So efficiency, unbelievable efficiency, and it snowball pays off. We have, most of us Americans have more money that runs through our banking accounts in a 3-year period to pay off our mortgage in full. I mean, we have a lot of money that runs through. So now this money actually is an active participant in paying down the largest debt that most of us have.
Mhm. Well, I definitely have never heard of this before either. And so the first thing that I'm thinking of is when you're saying, okay, this deposits and it immediately pays off your mortgage. And then someone's like, you're saying freaking out because they're like, oh, I have to pay for groceries and gas and all the things. So then are they just using a debit card again, or they're paying off a credit card every month through that line of credit, which then slightly increases the loan balance again? Or how does that work so that they do
Yeah.
have living expenses that can be paid from the money that they're bringing in?
Yeah, great question. So yeah, all of the above. Okay, so it literally is becoming I mean, you're not forced to do it, but when you understand the magic of this, you want to do it. All of my money is put into my all-in-one checking account and thus pushed to my mortgage. Okay, and so for me, I'm a numbers guy and I'm a money guy and I deal with this all the time. So guess what? I live my life on credit cards.
Mm-hmm.
Yeah, credit cards. Do I ever pay a dime in interest? No, no, I do not. But I abuse that. I abuse that. They're going to give me free miles. Oh, fantastic. They're going to bet that I can't, that I don't have the discipline to pay that off each month in full. Okay, I'll take that bet. And so worked perfectly with the all-in-one because guess what? My all-in-one account has no clue that I'm spending money all month long, which
Mm-hmm.
means my calculation of interest is being made each day on my full bounty of my income, all
Mm-hmm.
to get to a point where statement balance is paid auto draft as late in the month as I can. And
Mm-hmm.
yes, what happens is the balance does go up because remember, all of our money is in this account. So yes,
Right.
it goes up by whatever, like our, credit card statement balance, it goes up. So that balance goes up, but it never goes back up to the original, right? Or it shouldn't, or you shouldn't be doing this
Mhm.
loan because you don't have any excess money at all. And that's a good point. This is not for everybody. This is for those of
Mhm.
us who are discipline savvy and have extra income. If you
Mhm.
don't, you're rubbing two pennies together, probably not the loan for you. A 30-year fix is fantastic. Like we wouldn't own
Mhm.
homes if it wasn't for that. So this gives us the ability to, yes, the balance goes up and thus our calculation goes up. But if you think about what I just said, the credit card statement balance gets paid late in the month. Most of us
Mhm.
get paid again
Mhm.
on the first, usually. And so guess what? Then that balance goes back down again. So the higher calculation of interest only happens for a short period of time, but it's never going back up to that original loan amount. And that
Mhm.
is compounding crazy interest savings.
Sure. I can see exactly why this is so helpful. I mean, other people may not understand either, but being in finance, I have a bookkeeping company and we deal with all of this too. So I understand, that daily calculation of interest. And so most people have something sitting in a non-interest bearing checking account, just waiting to pay those bills too. And so having this go and reduce that for maybe it's 20 days, 25 days, even, where they don't have that higher interest because money was sitting in that account till they're paying that credit card bill down. And again, same thing, use your credit cards effectively, but pay them off, right, every month so that you don't have
Exactly,
that interest
exactly.
on that
So there
too.
is a way to, again, this is efficiency at its core. And so once this
Mhm.
starts, and this, mind you, the mortgage came out like 30-year mortgage, FHA, FDR, 1934, I believe.
Mhm.
Okay, we've been doing this as a culture for years and years and years. This is ingrained in our minds of, wait, these are separate. Wait, this needs to be this
Mhm.
needs to be that. This is a psychological deal that I work with every day. My average consultation for the all-in-one loan is an hour and a half to 2 hours long. No joke. And
Mhm.
not because I necessarily need to take that. I want to take that time because there's some psychological unpacking that I need to do with folks around money and around their
Mhm.
mindset and everything, and breaking down these barriers of what we've been ingrained in thinking for so long. And it's
Mhm.
real. It's real. Like, everybody tells us what to kind of think when it comes to mortgage, and those things are they're pretty deep ingrained. And you want to talk about being ingrained. I'm a 20 years veteran in the mortgage business. This is what I do and all I've done. And so you want to talk about a like taking a minute to really wrap my head around a new concept. It took me a while because I was
Mhm.
really ingrained in it. But once I understood, I was like, oh my gosh, I'm not going to stop. I'm not going to stop spreading this knowledge. Not that everybody needs to do it, just people need to know that
Mhm.
there is something different out there.
Sure.
And whether it's for you or not, that's up to you.
Mhm. I would love for you to talk about then some of the biggest misconceptions that people do have when it comes to mortgages and managing money. You were talking about the mindsets and having to really unpack that. So that's because of these misconceptions too. So can you talk about those?
Yeah, so I think the biggest misconception that comes to my mind right now is, is this like the COVID rates. Okay, so we call COVID rates so many people have these rates of 3%, maybe even 2%. This
Mhm.
crazy, and what we call it is free money. Okay, that's what it's
Mhm.
called. That's what people say. This is free money. Okay, so what happens with that is really interesting, and I don't think a lot of people are talking about it. So I don't know the last time you've done the math on what the even 2% costs over 30 years, but it's not
Mhm.
free. It's not free at all.
Right.
And so you hear, so because this term of free money gets thrown around, people are like, on average, the Americans are 4% of Americans are actually consistently reducing their principal on their mortgage, meaning paying a little bit extra principal to pay down their mortgage
Mhm.
and pay it off sooner.
Mhm.
4%. Okay.
Mhm.
So I think what's happened is, I call it the golden handcuffs. We hear free money. Oh, I'm not going to, that's so cheap. Why would I throw any extra money at that? And so now here's another statistic. The average American right now with a mortgage is 54 years old. Okay.
Mhm. Wow.
Guess how
Yeah.
much time they have left?
Almost 30
26
years.
years.
Okay,
Correct.
see.
Okay.
Mhm.
So, and then you're dealing finance. So most people, Americans, are trying, they will retire, whatever that means, right? Once they've paid off their mortgage. Okay, well,
Mhm.
54, 26, when are you going to pay? You're never going to. Okay, so you're
Mhm.
having to build this into your lifestyle, and it's and your budget and everything else. And there's just, and it's just, we just kind of feel stuck. So I call it the golden handcuffs. Oh gosh, I can't
Mhm.
do something different. Rates are like three times
Mhm.
what they were before, so I can't do anything different because I would, but literally, when depending on the person, I have a simulator that I run through with people, and I can compare a a low interest rate versus the all-in-one and their exact scenario, and it will show a side-by-side comparison of this, and it is absolutely wild.
Mhm.
how much more efficient and how quickly and how much interest they save, even though they have this way lower interest rate and this is way higher. And then some people will say, well, wait, I can do the same thing by just reducing my principal. Remember,
Mhm.
4% do it consistently. And I say, okay,
Right.
are you going to do that? No, I'm not going to do that. And also, why? Why do a lot of people not do it? Because once you've done it, what have you done? You've locked that money inside of your mortgage.
Mhm.
You can't get access to it. So what if you need access to it? Guess what? I get those phone calls. Hey, Mike, I need to put a kid through school. Hey, Mike, I need to pay off debt. Hey, I want to buy investment property. How do I get access to my equity? All these, they need to get another mortgage in order to
Mhm.
do that. Whereas the all in one, it's literally the name is genius. It is. It's all in one. It
Mhm.
creates this where you should not have to do another mortgage because as you build it down, bring it down, you have access to those and it's snowball paying it off so much sooner. And then guess what? At the end of it, you still have access to these funds. So if
Mhm.
you do want to retire, and you've paid it down to zero, guess what? You can supplement your retirement inside your all in one mortgage because you still have access to that hard earned equity. It's
Mhm.
crazy.
So somebody does then have to get into a whole new mortgage then with this. It's not like they hear about it and they're like, well, I have a mortgage. Now I want to just open this line of credit and it's going to do it. It actually has to be redone.
Yep. Yeah. So it's paying, it's a true, like if you have an existing, like me, I'll just be transparent. I had a COVID rate. I had a 3.625.
Mhm.
And I refinanced into this loan. So I've had it for about a year now. So I'm drinking my own Kool-Aid 100%. I have two of them actually. I bought an investment property with it as well. So yes, it replaced my mortgage. It
Mhm.
became my mortgage, paid off the existing mortgage. Now, in the future, it does sound like we are working on, ability to do a second or
Mhm.
behind an existing first. But today, as we speak, it is not present. Our company is working on Bank CMG, and that will allow for a bunch of different all-in-one type products within the banking
Mhm.
industry. So, but that's not here today.
Mhm. Interesting. Okay. And are regular brokers able to do this too, or is it specialized where it has to be someone that is in this specific thing that can offer it?
Yeah, this is a proprietary product, so this is our baby, which is why I didn't really know about it
Mhm.
for my career until I moved to CMG in 2024. So there is a select few brokers that have been given access to it, but it's kind of different, a little more expensive and stuff through them. So really,
Mhm.
it is a proprietary product to us at CMG, which by the way, we're all over the nation, and I have continued to get my license in more and more states. So I'm licensed, and we'll give that information at the end. But I'm licensed in many states throughout the nation in order to
Mhm.
serve the people that are coming to me wanting to take advantage of this program.
Okay. So when someone starts like implementing these strategies, what is the first positive change that they notice when using this product?
Yeah, their payment goes down. Their payment goes down. They see it. And so it's kind of cool because when you get a statement from this, it takes some getting used to, but you literally, it shows you your daily interest,
Mhm.
and you see it go down. So you can
Mhm.
see, so that's pretty rewarding. It's a very odd deal because it's actually the only mortgage I'm aware of that you're actually rewarded for discipline.
Mhm.
And so you actually can see that, and then as time goes by, you're going to see your payment, your obligation goes down more and more all the time.
Mhm.
So I guess I should say I mentioned the calculations of interest. This happens for a 30-day period. Individual interest calculations for a 30-day cycle based upon the balance that you are driving down. Those are
Mhm.
all added up for 30 days, okay, in arrears, And then on the 21st of the following month, an interest only, so all those 30 days, an interest only payment is made on your line of credit. So automatically, you don't, it's not something you have to set up. It automatically is going to, so your line's going to go up by that interest on the 21st of each month. And so it is a interest only payment, but if you
Mm-hmm.
think about it, the mortgage is principally first paid
Mm-hmm.
because you're reducing all along. So
Mm-hmm. Makes sense. Yeah, I see too that what I would think might happen, I don't know for sure, but if someone maybe who was not as disciplined with their, finances and would spend money a little more frivolously than maybe they realized, when they start seeing how much they're paying down, might become more strict on their, the excessive spending, right? Or the things that maybe they don't have to have, they're more wants than needs. Like, so are you seeing people that are actually, changing some of their habits to make sure they're having more paid off and getting those mortgages paid much quicker and saying, well, I'll sacrifice now a little bit. I still can have fun. I could go out. I could have a great time, but maybe I don't go out 5 times a month. Maybe I go out two.
yep. Yeah, absolutely. That's well, one of my um, the folks that it was a repeat client that I did this for. I've actually shot a video testimonial that's on some of my socials and stuff with them, husband and wife, and he literally said that he's almost addicted to that process, what you're explaining, and so much so that he also looks around and goes, "Oh, I haven't rode that motorcycle for like, however long. If I
Mm-hmm.
sold it, I could put that in my all-in-one account, and that would say." So he literally looks around and looks for things that he can sell so he can put into.
Mm-hmm.
So it's kind of for those of us who are high achievers, it's a
Mm-hmm.
mortgage that allows us to win. Like it
Mm-hmm.
allows you to be a high achiever in. A regular mortgage doesn't really care if you're a high achiever. Okay? Because even
Mm-hmm.
if you bang away 200,000 or whatever and you throw it at your mortgage, what does that do? Well, you just locked up $200,000. Did it change your
Sure.
payment? Nope, it didn't. Unless you
Mm-hmm.
refi or you have a recast feature, and that's a whole nother story, right? But this is
Mm-hmm.
literally changing that day. Your calculation
Mm-hmm.
just changed that day when you flood that. So yeah, it's just so it really it gives you we started this call by talking about efficiency. It gives you the opportunity to actually have an efficiency and control and freedom, most importantly, over something we've had the opposite
Mm-hmm.
of. So it creates a really awesome way to pay down our mortgage, but also the flip side of things. I like to bring this up. How many people can we think of in our life that got stuck in a career, and because the mortgage or just housing payment was coming each month, no matter what, they stayed in that
Mm-hmm.
career. They didn't have a put because they
Mm-hmm.
couldn't put enough money away, couldn't save enough money to make a shift, and so they're miserable, right? So, but if you think about the all-in-one concept, you've paid down your mortgage significantly because that just automatically is happening with this. There's no way around it. It's going to happen. It's so efficient and
Mm-hmm.
compounds over time that if you're like, you know what, I really don't like this. I really don't like the trajectory and the path that I'm on. I'm going to quit my job and I'm going to go back to school and whatever. So what would happen if you put $0 in your all-in-one account? And so I just
Your
and I
debt
just asked
stays the
that to
same, right?
people. Yeah.
Mm-hmm.
So what happens is, oh my gosh, God forbid, your hard-earned equity makes your interest only payment for you. And then
Mm-hmm.
the next month it does it again. And it inches up a little bit at a time. But yet,
Mm-hmm.
on the flip side of it, because it should be an investment in getting into a better career and being more happy, and more happy means you typically make more money. And guess what? You'll make up that time and you're able to push the reset button on something we've never been able to push a reset button on. You have to sell
Sure.
to get access to those funds or refi. And guess what? You're not refined 100% unless you're a veteran.
Mm-hmm.
And
Sure.
that's the whole nother conversation.
Mm-hmm. So I assume obviously going into a new mortgage then that usually takes time and paperwork and all of the things. So it might take a little bit of time before they can get into this. So do you have maybe another suggestion for what they can do right now to create that greater control and flexibility before they can even get into an all-in-one mortgage?
Yeah, good question. I mean, just so you know, the all-in-one mortgage is a conventional loan, so it's no different than what people have done in qualifying for a normal loan. It's a little, of course, harder. It's
Mhm.
not everybody's going to qualify for this. So it is a little bit harder. Debt to income thresholds are lower. It does require some reserves, so you have to show that you actually can put money away or have invested
Mhm.
money because those are discipline features. Oh, by the way, this has never had a default. It's the only mortgage in American history that I'm aware of to date that's never had a default in 20
Mhm.
years. So,
Wow.
anyways, but as far as like, normal closing times, I mean, I close these inside 30 days all the time. So
Mhm.
it doesn't take long. So what kind of things can you be doing? You kind of touched on something, I think, with budget. People, especially those that would be interested in this type of loan, are typically people who have maybe some higher income and discretionary income. And when that happens, what do? We don't pay attention as much as maybe if we were tight. So we just kind of spend. So I do spend some time with people working on budget, and it's a great time to go, oh, actually, we don't really know how much is going out each month.
Mhm.
Well, it's probably a good time to check that out. And now you've got a reason to do it, you know.
Mhm.
So yeah, that's kind of what I would how I'd answer that. Budget.
Perfect. Well, this has been very interesting and informative. I really enjoyed the discussion that we've been having, Michael, but I know we're coming to the end of the time we have together. So I wanted to ask, do you have an offer that you would like to extend to our listeners? Sorry. And if someone is interested in more information, how can they contact you?
So my offer is, that consultation that I mentioned is free, and it doesn't matter whether you're here locally or clear across the nation from me. Again, we're doing this on video. It's a beautiful thing. I share my screen. We run through simulations. I make it really real for you. So free consultation, and it doesn't cost you anything but time to be educated
Mhm.
on something. I'm an educator. I'm a coach at heart. And so that's my offer. My expertise, my knowledge, my care is my offer. How you can get a hold of me? So I do have a team. I can't do this without a team behind the scenes. So it gives me time to be able to do things like this. So we can be reached at. You can look us up on our website at newmangroup.com, and Newman is spelled with two N's on the end, so NEWMANN group.com. Our phone number at 541-227-2727. And yeah, if you look hard enough, you shouldn't have to look too hard. You'll find information, and whether it's LinkedIn, Instagram, Facebook, I'm shooting videos, putting out content, even AI. We're speaking to AI in regards to this, so AI learns about this because people are checking it on AI for sure.
Mhm. Perfect. Well, Michael, thank you so much for being on my show today and talking about this topic and giving the practical insights around money and mortgage efficiency through that all in one mortgage. I really appreciate it.
Yeah, thank you so much for the opportunity to chat with you and your interest in learning something new.
Mhm. And to the listener, thank you for tuning in to the show. I hope this conversation gave you fresh perspective on how small shifts in the way you manage money and debt can create meaningful long term impact. And if this episode gave you extra value that maybe you didn't even know you were going to get today, would you please share it with someone else who may benefit from this conversation as well? And if you'd like to hear additional content, you can find access to that in the show notes. Thank you for tuning in today. Would you please share this episode with those you know and leave a review on your favorite platform? And if you find our show informative, would you consider being a financial sponsor to help me continue my mission to educate business owners? A link is located in the episode description, and no amount is too small. I'd really appreciate your support. If you are interested in connecting with our guest and receiving the offer they had to share, a link to our resource page is in the show notes. Finally, if you have any bookkeeping or payroll needs, reach out to us at 310-534-5577 or contact@abandp.com. My team and I are eager to assist you. Until next time, have a great day.
Thank you for listening to Biz Help For You. Please join your host, Candy Messer, again next time. Have a terrific day.